This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Jess, Menton, and Madison Mills here in the Bloomberg Interactive Broker Studio. And Maddie, I know how much you enjoy talking about the consumer, also the retail space, because we've talked so much about these big earnings coming up, especially with Amazon tomorrow. But we have another look as far as how retailers really struggled in the midst of COVID, and especially when it comes to the inventory issues. So who better to come in and chat with us about the startup space, but then also the retail outlook here as we head into close to the fall season, obviously toward the end of the year, the holiday shopping season, with Ari Trousdale, who's founder and chief executive officer of Crisp, who's here in studio with us. So it's always great having someone here. Thank you so much for coming into the Bloomberg office here in New York. Tell us first off about your company and what it is you do.
Great, yeah. We work with a lot of large retailers, about $2.5 trillion of retail spend to the retailers we work with. And then we have about 500-600 large brands, small brands on the platform. What we help with is the exchange of data between retailers, large distributors, and also the large manufacturers and the large brands. So this has historically been done with a technology called EDI, which was invented 50 years ago, the year I was born, and there hasn't been a lot of innovation in kind of this connective fabric that ties all these important trading partners together. But through a platform like Crisp, they can exchange information much better, so everybody wins.
So what kind of data do you help these retailers? And again, as Jess mentioned, you've got the names like Amazon, BJ's, Aldi, Target, Whole Foods on this list, among many other big ones. What data do you provide them, and how do they leverage that data into action?
Yeah, it's particularly in that interface between the large retailers and the brands, and they typically have need for data around understanding how much is on the shelf, how much data is actually, or how much is actually sitting in the distribution center. What was the price of
How
the
do you
product?
help them know that?
So we actually connect into a lot of these legacy systems that the large retailers have. So they have point of sale systems, they have warehousing systems, they have logistical systems. So we help connect into these systems and bring all of that data into the cloud so that everybody can access this throughout a supply chain. So if I'm now on the brand side and I'm planning an advertising and marketing campaign, or I want to push a new product out, or I understand how much I need to manufacture in order to meet the demand, now they have much better view of everything that's happening across all of the different retailers.
How long does it take for them to access that type of data?
So it's been a big part of the reason we've been able to get so many on the platform. We invested a huge amount of capital into building this infrastructure, but once they come on the platform, it takes less than an hour. And there's a lot of changes in the industry now, and some of them are around advertising, right? So that the retailers are leveraging their data and their audience to drive more advertising revenue. They're also leveraging it in data sharing programs. So you have the large Amazons of the world, but you also have like a Walmart, for instance, that have incredible bottom line money now from advertising. And they also have a different program, which is called Luminate, where they actively share the data out with their suppliers. So we help in that interface. How do we get all of that data out of Walmart and Luminate and into all of the different systems that a brand have? They might have cloud systems, they have procurement systems, they have sales systems, they have all of that, and they want to have one view of data across all the different places that they need the data.
So that's kind of a solution for when there might be an undersupply of inventory for a product that's about to get a big marketing push. But what about excess inventory? We saw that coming up a lot during the earnings cycle last season, particularly with names like Target. How does your tool help these retailers with that?
Yes, so they calculate based upon sales velocity, so they understand how much each store is selling of this particular product, understand pricing, and then understand how much inventory actually sits out in the different stores and how much inventory sits in the distribution centers that support the stores. So with all of that kind of real-time information of consumer behavior, because we see every day kind of what's happening in the stores, now they have an ability to do much better forecasts of how much products they actually going to need. And before it was much more reactive because it was based upon a purchase order that would come out, but now actually the suppliers and the brands have an opportunity to kind of see what's going on and then produce the right thing, because it takes a while to produce these products. And that's kind of, I think what you're alluding to is you saw this huge build-up in inventory, because it takes, if you push the button today, it's going to take 3 months for this product to actually arrive. So being ahead of that is kind of what the tool helps with.
Talk to us about this startup credit crunch, because we're coming off a few months ago, obviously, all of the drama that went on with these regional banks with SVB. I was curious, do you have exposure towards any sort of those banks that were in California, and how you view that whole situation?
Oh, that's good. Big shift over to something that makes me very stressed right now. I can bring up my SVB card that didn't work for a couple of days. But now I feel actually very good and comfortable around it with what the government did there to help the banks. So that prevented a big crisis, I think, for startups. I actually took the plastic of the televisions for SVB when they moved into New York 20 years ago. So I've been with them for a very long time.
Wow.
And kind of seeing how that changed so quickly. But now also there's a lot of other banks that are coming into the space and seeing that there's a great opportunity in this area. Plus SVB is actually continuing operations very well under new ownership.
Mm-hmm. Do you see any sort of red flags brewing up kind of more broadly with startups at this point?
You know, I think, yes, I've been doing this for 25 years. It always goes in these huge waves of way too much money that comes into the space, and that drives valuations up and everything. And now the pendulum is certainly on the other side of that. And I like this period more because it actually weeds out a lot of the non-real type of startups. So I believe if you solve big problems for big companies and drive high ROI, now this is something that's very investable and exciting for investors to be a part of. So I love both phases in a way, but I actually like this phase a little bit more than the frothy phase.
Right. Well, it's great getting your perspective on all things when it comes to startups, but then also what your startup has been doing. So that's Ari Trosdale, founder and chief executive officer at Crisp, joining us in studio with Madison Mills and myself. So great getting your perspective on all of this.
Yeah, really interesting to think about how startup funding and credit tightening is kind of impacting what we're going to be seeing down the pipeline, and of course getting a check on the retail space as well, Jess. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
All right, so in terms of needing some help here, I feel like I'm the one who needs help sussing out the market moves today, because obviously this Fitch downgrade is a huge move, but it seems like the Treasury Department is the real driver on the day, because when it comes to that Fitch downgrading, it feels like traders don't really care, economists doubting the credibility of the move. So here to make sense of the day's trade for us is Elena Papina from Bloomberg's equities team and our chief economist, Anna Wong, joining us from DC. Elena, I want to start with you. Thank you so much for coming on. It's great to have you here. From the perspective of the market's reaction, would you say the Fitch rating is kind of a non-event today?
It was a non-event yesterday after the bell when the decision broke, and the futures were on the SPY ETF were down about 0.1%. So it wasn't a big reaction. Then earlier today, when we got the announcement about the Treasury Department increasing the auction size, that's when the decision actually became a much bigger impact on the stock market. So we are now down more than 1% on the S&P 500. Not an unusual move, but it is getting some investors worried about whether there is more to come.
I want to bring Anna into this conversation because do you think that this move was actually warranted by Fitch?
Yeah, so I think the substance of it was, which is the fiscal trajectory of U.S. Government balance sheet, is warranted because part of it is that just 3 weeks ago the U.S. Treasury released the year-to-date picture of the fiscal deficit, and actually it surprised many people by how weak it looked. In fact the deficit for 2023 is expected to be much larger than last year, partly because of weaker receipts. So that was, I think, perhaps one piece of information that Fitch was waiting after the debt ceiling was resolved in thinking, should we downgrade or not? So because this year fiscal deficit for U.S. is expected to surge to 5.7%. And then on the longer term, the fiscal picture also doesn't look good. We forecast that 2033 fiscal deficit, the debt to GDP ratio would be over 130% of GDP. So yeah, on that grounds, I think the decision was warranted.
Well, Anna, I want to stick with you for a second because we are obviously seeing some comparisons to 12 years ago today. A lot of people saying that it's a completely different situation. Can you tell me exactly, in your view, how different the backdrop is today versus what we saw with the S&P rating downgrade in 2011?
Well, first of all, I would say that my view is different than the predominant view in the market, that ultimately the market will shrug it off, this downgrade. I do think there's a risk that ultimately the market won't shrug it off and we'll be having a repeat of 2011. So I think most people think that it's different than 2011 because back then we still have the European sovereign debt crisis, and today we have not. Well, today we still have a weakening global economic backdrop. Germany is looking like they're in recession. China is fueling hard landing scares. And U.S. also is actually not as strong as many people think. That's reason number one. Number two is, and right now, when we look at the U.S., various asset market like VIX, equities market, there's just this sort of complacency, and people have been ignoring the negative data surprises in the last couple of months, and I feel like people are kind of just so in love with the soft landing narrative that I think markets are actually due for some kind of correction. So in that sense, I think we're pretty vulnerable at this stage.
So Elena, with that said, and looking at the NASDAQ 100 up, 40% this year, and then the S&P 500 also up double digits, is it an excuse to take some profits?
It actually can be. A lot of traders have been telling me that there hasn't been a catalyst to sell. We did know that positioning became overextended. It was time for a breather, and now comes the catalyst. Now the bigger question is it going to be a 5% correction? Is it going to be just a buy the dip situation with stocks rallying tomorrow and into the weekend? So that is the big unknown. And I want to talk about earnings because earnings have been a big supporter to the S&P 500 rally over the first quarter and early over the second quarter results. We do expect to see Apple and Amazon reporting tomorrow, so that can be a potential catalyst. If they do report disappointing earnings that trail expectations, so that could be a catalyst for a much bigger and potentially more prolonged sell-off.
What does positioning tell us at this point as far as who could potentially be selling? If we're talking about hedge funds, is it too early to really tell that versus retail investors?
That's a great question, but we don't know yet. We do know that retail investors have been buying into last week. So last week was the first one when they were net sellers of equities. Whether that's a smart move, considering today's rout, is yet to be seen. But yeah, they kind of pared back their appetite after jumping in earlier in May and earlier in June. So if hedge funds decide to become big sellers, that may be an interesting story for sure.
And Anna, bringing you back in here, I'm curious about how you're viewing the move from Fitch from an economics perspective, because as you noted, we're hearing a lot of pushback today. Jamie Dimon coming out against the move as well. Does this hurt their credibility, and does that matter?
Well, I think Fitch is kind of bringing reality back to everybody. I think, of course, from Jamie Dimon's perspective, a market rally is great for JP Morgan, right? But I think, as I was saying before, the market has been complacent in recent weeks because of this, prevalence of the soft landing narrative. And on the eve of every recession in the past, half a century, the soft landing narrative tends to dominate too.
Yeah.
And Fitch sorts of put the focus back on these ugly fiscal numbers. And I thought that one of the most interesting things that the Fitch downgrade caused us to notice is that these the Treasury data showing the receipts and deficit that was released a couple of weeks ago, it shows that receipts was weaker than is weakening. And usually before a recession, receipts would weaken, and it's always the case. And I think it does confirm our suspicion that maybe a lot of the activity data is overstating the strength in the economy.
Something I'm curious about, Anna, is whether or not, when you're thinking about more market-moving type rating agencies, whether it's Moody's or S&P, do you think we'd actually see downgrades like that from them?
Well, S&P already downgraded back in 2011, and they never re-upgraded the U.S. So right now, 2 of 3 major rating agencies have taken away the U.S. The stellar rating. So it's just down to Moody's now.
Yeah, and on that, I guess, Elena, I want to ask you kind of what Anna was saying earlier. Anna mentioned that you think that the market slugging off this downgrade is not going to be the case in the coming weeks. Do you agree? Do you think that the market is going to start to have a more prolonged reaction to this?
It's interesting that August and September are traditionally, seasonally, the weakest months of the year, going back the past 30 years. So there may be a reason for a bigger sell-off just because of a confluence of factors, right? Fitch obviously was a big surprise for a lot of traders, thinking that we're going to go to the moon. It's not the case, and the positioning looks extended on several fronts, and seasonality isn't, adding confidence into the stock market trajectory in the next couple of weeks. So there might be some choppiness in the next, 3 to 4 weeks, or maybe a couple of months even.
Something I'm curious about, Anna, is whether or not this is a wake-up call for Congress.
Yeah, I think the debt ceiling fight back in June was a missed opportunity for both sides to address the real fiscal challenges, which is Social Security, healthcare, right? I mean, 20 years ago when Al Gore, was it 20 years ago? Yeah, 20 years ago when Al Gore was debating George Bush, they were talking about reforming Social Security and lockbox. Now we don't hear that anymore in this presidential debate. I think those issues need to get back on the table, and I think when 2 of 3 major ratings agencies have downgraded the U.S., it certainly is a wake-up call.
What's the likelihood of this actually being a wake-up call, though, in our next 20 seconds, Anna?
I don't think, I'm not optimistic that it will truly be a wake-up call.
Wouldn't it be great if the big market-moving, headline-breaking news was, in fact, a wake-up call for action?
Right.
Anna, thank you.
Not.
Thank you so much for joining us. Anna Won, our chief economist, joining us from D.C. And Elena Popena, thank you so much. It was great to have you in studio with us.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It is time for our Bloomberg Businessweek segment. Joel Weber is in the house with us in our Bloomberg Interactive Brokers studio. Joel, thank you so much for coming in today.
Oh, it's always a pleasure.
It's always a pleasure. We're going to talk about Amazon as the next potential grocery store.
That's right. So Matt Day has a very interesting story in the forthcoming issue, about kind of a reboot that's going to happen at Amazon. Obviously, Whole Foods part of that portfolio, but there's a lot of other things in that portfolio, and that's how the story basically goes through what Amazon's going to do about it.
Incredible. So I think this is a great time for us to bring in Bloomberg technology reporter Matt Day, who's joining us on Zoom here. Matt, thank you so much for joining us. I know you just heard Joel's intro, but tell us a little bit more about your story and what people need to know about it.
So Amazon, over maybe call it 20 years of experimenting in groceries, they have a mishmash of businesses, right? They have Amazon Fresh, where they'll deliver, to your home fresh food. They've got Whole Foods, which they bought 6 years ago, and they've got Amazon Fresh, the brick and mortar store. There's 44 of those, and then Amazon paused when they were cutting costs about a year ago. They're trying to kind of meld those together. They're trying to expand kind of on all fronts. Amazon basically took a hard look at its grocery business, said, we still think we want to be here. We just need these pieces to kind of play nicer together. And so they've announced a bunch of things. Maybe the one the stopper's going to notice first, you don't have to be a Prime member to order groceries at Amazon anymore. That's a first for them since they started selling groceries online in 2007. Previously, you always had to pay into Prime. Now, it's just kind of a free-for-all, or at least some sort of fee to gatekeep that. So they're really trying to light a fire into this business after flailing for a few years.
Why do this? Why do any of this? What's the problem that they're trying to solve?
I mean, the problem is sort of size and scale. Amazon wants to be a big deal. Amazon wants to be a big retailer. And to be a big retailer, you have to sell food, right? To be a big retailer of a certain size. That's the Walmart formula. That's how they went from, very big superstore to the world's biggest retailer. So over the years, we've heard tell of, Jeff Bezos back in the day saying, listen, we're not going to be a $100 billion business unless we sell groceries, right? Unless you get that touch point with customers and, you are the meat and dairy run that causes folks to, oh, hey, I'll, grab something else while I'm there, right? Amazon's very cognizant of that fact that it's just the most common shop people make. And if you want to, be a big retailer, it's where you got to be. Their recent learning, though, is that you also have to be there in person. Amazon learned, kind of the hard way during the pandemic and coming out of the pandemic that you need a physical point of presence to make a difference in grocery, which is not their comfort zone, to say the least.
It's interesting and a little jarring when you see this table in the story of largest U.S. grocery market by share. Walmart number 1, Kroger number 2, Costco number 3, Albertsons number 4, and then you get to Amazon Whole Foods. So obviously there's some big players there, but there's a lot of ground that they have to make up to take on any of those. So realistically, how far do they think they can go just by doing this modest reboot?
I think it's going to take years, and they're cognizant of the fact that it's going to take years. Their new grocery boss, Tony Hoggetty, told me that they're starting to tout this line that, listen, all the grocers that are on that list, they've been around for 50 plus years, right? We're just getting started. We think we're going to be in this for the long haul. But analysts are pretty sober on this, right? Amazon needs hundreds more stores, probably, if not thousands. Amazon needs to keep working on developing a supply chain in fresh food, right? Like the reason Amazon and Kroger can command such good prices from the suppliers if they've got stores everywhere, right? Amazon has none of that so far, and they're going to have to really work hard to get those kind of economies of scale to become a big grocer. So the way they're setting this up is this is kind of a decade or multi-decade project. They're not going to figure this out next fall or anything, but they say they're in it for the long haul.
Talk to us about the frustrations that customers have gone through if you have to check out through 3 separate carts and how that all kind of ties into this.
Yeah, this is really messy for Amazon, but they, if you want to buy stuff from Whole Foods, you have a Whole Foods cart and a Whole Foods delivery that you're going to be on the hook for. If you want to buy stuff from Amazon Fresh, same deal. And then maybe most confusingly, you can buy some kind of canned goods and pet food and other things you might find in the grocery market just on regular old Amazon.com. That is yet another delivery. So Amazon realizes that just doesn't line up at all to the way people shop today. And so they've said, either later this year, early next, they're fuzzy on the timeline, but they're going to smush all those together. So you've got one cart, one, ideally one checkout experience and one delivery afterward to get everything you need and make Amazon really a one-stop shop rather than the kind of the current hodgepodge.
So does that mean that if I go get organic groceries at Whole Foods, I can put a Coke and a bag of Doritos in that same cart?
Hypothetically, you can. And not only that, but they're going to let you actually get that in the roof of Whole Foods, which is a first.
That
maybe
is sacrilege,
like a red line
man.
to a lot of people, right?
Whoa.
Right?
Yeah, there's some Whole Food fans out there that just they knew it was coming, man. They knew it was coming.
No.
Yeah, and Amazon's trying to have it both ways a little bit. You can get your your junk food at Whole Foods, but it's going to be not on the shelf, right? It's going to be some sort of click and collect type deal where listen, Joel, you got to go get your organics at the end of the day. You order ahead, and you'll get your Tide Pods or Coke or whatever with it.
When I need Doritos, I just go to the 6th floor here at Bloomberg.
That's what I do.
To be clear, but
stuck up.
Confession.
No, but it's a great point, and you talk about this obviously in the story, Matt, that Amazon has a 13% markup on the online purchasing. It's just not the same price point as a Walmart. So what are they going to do about that?
They're going to try to get scale and try to drive lower prices. Amazon, when they bought into this business, they had an organic supply chain geared toward Whole Foods. They had, a set of suppliers that really aren't the same folks as are filling the shelves on Kroger and on Walmart. So they're just trying to get scale and negotiate a better deal. But I think they're also, they try to stay close to Walmart, especially on online pricing. But, when it comes to the physical Amazon Fresh stores they're rolling out, the kind of aim seems to be undercutting the conventional grocers, right? Undercutting your Kroger, undercutting Albertsons, but maybe coming in a little bit above the real big discounters like a Walmart or an Aldi or a Dollar General, speaking of things that are growing like crazy.
Okay, so does that mean then that the physical presence is going to grow dramatically of what we see from Whole Foods and Amazon?
If it works, they are rolling out a new version of the Fresh stores that they think are going to be more inviting and draw more people in. It's less tech heavy. It's more, traditional retail stuff, right? Holiday promotions and sales and stuff like that. If that goes to plan, they have hinted they're going to expand, but they haven't rolled out anything formal. But they've made clear that they want to take this nationwide and they want to take it bigger from here.
All right. Thank you so much for joining us, Matt Day, Bloomberg News reporter. And of course, we have our Bloomberg Businessweek editor, Joel Weber, joining us here in studio. Thank you both so much. You can find Matt's story on the terminal or online. Amazon kicks off biggest grocery reboot since buying Whole Foods. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Jess, Menton, and Madison Mills here in the Bloomberg Interactive Brokers Studio on a day where you're looking at the S&P 500 on pace for its worst day in a few months here. And who better to come in and chat with us as we only have a little less than 20 minutes before the closing bell than Nancy Pryl, who's co-chief executive officer and senior portfolio manager as Essex Investment Management on Zoom from Chicago. Nancy, thank you so much for joining Maddie and myself on what a day in the markets here. And I want to start off with just what's your view when it comes to the broader stock market reaction on the heels of obviously a confluence of a lot of events when you have, say, this Fitch downgrade, but you're also seeing a lot of activity with these treasury issuance in the bond market that obviously has made some big moves there in bond yields.
Well, we think that this move is really the pause that we needed. If you think about where we've come from this year, in the beginning of the year, almost everybody was very bearish, still worried about inflation, worried about an imminent recession, or maybe a not so imminent recession, but a recession nonetheless. And as the market's gone on, as we've gotten excited about generative AI, as we've gotten excited about the big cap, stalwart tech companies, complacency has started to build. And we've seen recently a crumbling of many of the bears who have been pivoting to bullish sentiment. We've seen massive short covering by hedge funds. We've seen money flowing into the market, both from institutions, but very importantly from individuals. And that's led us to a little bit of an overbought position where even though the earnings have been very good, in fact, better than expected, and even though the economy is proving to be resilient, expectations were just a little ahead of themselves. We think that the Fitch downgrade was the trigger that gave people who are getting a little bit cautious about this complacency the excuse to do a little bit of selling. But we think this is still very orderly and it's nothing more than a mid-course correction.
Is today kind of the perfect example of why we need to continue to worry about narrowness in a rally, specifically speaking about the Magnificent Seven kind of bringing up markets so strongly when you have a day where bonds might be weighing on those big tech names?
Yeah, well, I mean, I would say today the weakness is weighing on almost everything. It's a pretty broad-based sell-off, hitting both large cap, small cap, growth, value, et cetera. However, you're making a really good point, which is with a market that has been led by such a small sector of the market, and particularly by such a small number of names, that it's important not to overinvest in those well-recognized growth areas only, but to have a more diversified portfolio and to look where the strength is emerging. And what we have seen over the last couple of months is that the market is broadening. That strength is broadening. More sectors are participating, and really importantly, more market caps are participating. We've seen some strength building in those small and mid-cap areas that we had not seen earlier in the year. Those are still very attractively valued, particularly compared to their larger cap peers.
So how are you positioning then? Did you make any changes today with your portfolio positioning?
Well, we are not short-term traders. We are long-term investors. So although we do have some open orders, as we almost always do, it's not really driven by today's action per se. What we have been doing, though, and we've been doing this all year, is focusing on those areas that we believe will drive economic growth and drive that growth in a way that's better than expected, not just this year, but really over the next couple of years. To us, that means a big focus on industrials, on reshoring of manufacturing, reindustrialization of the United States and the world, infrastructure spending, the transition in energy and of the economy to a more electrified economy. So really building exposure in those areas and taking selective profits in those companies and those areas that maybe have gotten a little ahead of themselves. So taking our profits on stocks that are up 50, 60, 80% year to date.
What's your thinking then on which of those stocks you need to stay in for a second half of your rally versus the ones that you feel comfortable getting out of?
We think that the second half of the year will be led more down market cap. And we think it will be led more by companies. I would categorize them as GARP companies, growth at a reasonable price, rather than deep value companies. We think that the economy is likely to stay sluggish, but hopefully positive. We think, what we've been saying all year, and we're not changing our tune here, is that it's going to be a bumpy landing. So at times it may feel like we're going into a mild recession. At times it may feel like we're not, but that means you don't want to go deep value, but you want to focus on those areas where they have tailwinds on economic growth. To us, that means areas like environmental sustainability. So the companies that are doing traditional environmental management, you can think about landfills, you can think about incinerators, you can think about waste cleanup. We also want to focus on this transition to this electric economy. We want to think about the companies that are laying the groundwork for generative AI. Now, we all know about NVIDIA, but there are a lot of other companies that are below the radar screen that are also benefiting from the build out of these data centers. We, again, want to think about the reshoring of manufacturers, maybe semiconductor manufacturing equipment, factory automation equipment, those kinds of names that are selling at multiples that are less than 20 times, with earnings that are coming in better than expected, and revenue growth rates where they're seeing unit growth and not just pricing growth.
We still have about a little under 2 months before the Fed's next rate decision, but we do have Jackson Hole at the end of this month. What's your view on the Fed's rate hiking cycle, and do you think they are done?
Well, I think they are, in fact, data dependent. It doesn't feel like that all the time, but I thought from Chair Powell's last comments when he spoke, what was it, a week ago or maybe a week and a half ago, and he talked about the fact that they need to recognize the direction of inflation and not wait until we reach the target. And that's really the first time I've heard him say that, certainly at least in a long time. So what he said explicitly was that they will need to pause before we get to 2%. They will need to cut before we get to 2%. We just need to see clear indications, clear evidence that we're on the way there. Our best guess is that they won't actually say very much at Jackson Hole, that they will keep things somewhat close to the vest, waiting to see the data that comes out between now and September. The data so far has indicated that inflation will continue to moderate, and therefore they could continue to pause. My one hesitation there is that we are seeing some increases in oil and in food, driven mostly by what's going on in Ukraine and Russia on the food side with wheat. And that might muddy the waters a little bit in the short run. So we could see one more 25
All right,
basis
Nancy, thanks so much for joining us. Nancy Pryall, co-CEO and Senior Portfolio Manager at Essex Investment Management, giving her perspective here on the markets on a big down day here.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.